everyone, I'm Yabijans. Welcome to our discussions about inflation targeting frameworks in developed versus developing countries. I will start the introduction part first. So, as you know, inflation is a key economics issue that affects both developed and developing countries, influencing price stability, economic growth, and poverty levels. And no matter what countries, they will adopt different monetary policy strategies, such as inflations and exchange rates targeting to manage inflations. And the effectiveness of these strategies often depends on the strength of a country's institutions, the independence of its central bank, and overall economic stability. These are the simple ideas of our topic. Without wasting time, let's start our first topic, Jahida.
Hi, my name is Zahida. I will discuss about differences in inflation control mechanisms. First, monetary tools. Developed countries use advanced tools like interest rates, supported by strong financial markets. In developing countries, tools are more varied but often less effective due to weaker systems. Second, central bank independence. It is usually strong in developed countries, leading to more credible policies. In developing nations, central banks may face political pressure, which affects their effectiveness. Third, the drivers of inflation differ. In developed economies, it is mainly demand driven, so they focus on core inflation. But in developing countries, inflation is often supply driven, especially from food or energy shocks. Next, exchange rate regimes. Developed countries usually have floating exchange rates, which allow flexibility. Developing countries often manage or fix their exchange rates to stabilize prices but risk external shocks. Lastly, policy credibility. In developed countries, strong institutions help anchor inflation in expectations. In contrast, many developing countries struggle with low credibility, making inflation harder to control. So overall, while both aim to manage inflation, the tools, the challenges, and contexts differ greatly. So, any question?
Sorry, but you didn't mention subsidies. Don't they help to control inflation in developing countries?
Yes, subsidies are often used in developing countries to reduce the impact of rising prices, especially for essentials, but they are more of a short-term relief than a true inflation control tool, and they can cause budget strain or market distortions in the long run.
Wow, wonderful ideas from Jahida. How about you, Yuna?
Hi, my name is Yuna. I will talk about the role of central bank in inflation targeting. Inflation targeting is a monetary policy strategies used by central bank, whether in developed or developing countries, to maintain price stability. First, the central bank establish the inflation target and collaborate with the government and set explicit inflation target to anchor the expectation and guide monetary policy. For instance, the European Central Bank aimed for 2% inflation target over the medium term.
Setting a target makes sense, but how do central banks keep inflation under control or once the target is set?
That's a good question. Let's move to the second part of the role, using monetary policy tools. Central bank will carry out interest rate adjustment by modifying policy rate to influence borrowing, spending, and investment. If the inflation is too low, they might lower rates to encourage more economic activity. Another tool is called open market operation. For open market operation, central bank will be involved in buying or selling government securities to manage liquidity and influence short-term interest rate, which is buying bonds to inject money into the economic, encouraging lending.
All right. Thank you, Yuna, for that clear and insightful explanation about the roles of central banks in inflation targeting. Now I'm curious about the inflation and exchange rate targeting. What about you, Ifa?
Okay, so as you guys know, inflation targeting and exchange rate targeting are two key strategies used by central banks to manage their economies. Inflation targeting is used when their goal is to keep prices stable, which helps maintain consumer and business confidence. Countries that have this policy typically have strong central banks and well-developed financial markets. On the other hand, exchange rate targeting focuses on keeping a country's currency within a certain range against another currency. This approach is more common in developing countries where economies are often more vulnerable to external shocks. So, by stabilizing the exchange rate, Government can build investor confidence and reduce inflation.
Can we know some examples of the country that use both policy?
Sure. Inflation targeting is more common in developed countries like New Zealand, Canada, and Sweden, while exchange rate targeting is used in countries like Qatar and Oman.
Seems like everyone understood about inflations and exchange rate targeting. How about the impact of inflations on economic growth and poverty? JC?
Hi, my name is Jessie. I will talk about the impact of inflation on economic growth and poverty. The impact of inflation on economic growth and poverty differs between developed and developing countries due to differences in structures, institutions, and policy effectiveness. For developed countries, the impact on economic growth is small to moderate inflation. For instance, central banks like the Federal Reserve and the European Central Bank have tools to manage moderate inflation and thus maintain economic stability. However, unexpected inflation spikes, such as the UK's 3.5% rate in April 2025, can also strain monetary policy and slow growth. Meanwhile, the impact of inflation on economic growth in developing countries is due to economic instability. For example, hyperinflation in Malaysia can lead to currency depreciation, capital flight, and reduced investment, hindering growth. Besides, the impact of poverty in developed countries is that inflation can outpace wages growth, reducing purchasing power, especially for low-income households. Meanwhile, for developing countries, inflation increases the cost of living. For example, rising food prices in India can lead to increased poverty and malnutrition. That's all from me. Back to you, Ejen.
All right. I will talk about the challenges in inflation management in emerging economics. Unlike developed nations with robust institutions and stable monetary frameworks like Turkey and Brazil, emerging economics often grapple with limited central bank independence and on-core inflation expectations and heightened exposures to exchange rate volatility and global commodity shocks in developing countries like Sri Lanka. For instance, Brazil has struggled with fiscal dominance, where government deficits financed by money creations. Meanwhile, developing countries may lack the institutions' capacity and policy tools to effectiveness address inflation resulting in several economic crises. I think it's the time to conclude all the points. If I can help us to conclude.
Okay, so here's what I can conclude from our discussion. Number one, inflation targeting is a way for countries to control inflation by setting a clear target managed by the central bank. Number two, central banks are more independent and use interest rates to maintain inflation stability on developed countries like the US or UK. Number three, inflation control is sometimes done through exchange rate targeting on developing countries like Sri Lanka. Number four, people face global price shocks, political pressure, and weak institutions. Number five, developed countries manage inflation with strong systems, while developing countries may find it more challenging due to lower trust in their central banks and limited tools. So I think that's all for our discussion today. Thank you.